Hello everybody. Following on from my previous video, what I've decided to do is to break some of our results up into small components and talk about different areas of how transaction capital has performed over the last 6 months and how we will continue to perform going forward into the next half of this financial year. TCRS's diversified business model enables it to perform well in both a positive and a negative environment. Firstly, TCRS is diversified across 4 business activities. Within collection services, its largest business activity, TCRS is a diversified revenue model, allowing TCRS to be defensive. Agency collections thrive in a positive consumer environment, whilst the negative consumer environment is conducive for the acquisition and then collection of NPL portfolios. This year in South Africa, excellent performance in the acquisition and collection of NPL portfolios positively offset the expected reduction in agency collection revenue due to the difficult consumer environment. You can see from slide 27 that TCRS is diversified further across geographies, sectors, clients, and lastly, mandates. In South Africa, TCRS continues to be defensively positioned in a difficult macro and socio-economic environment, placing pressure on consumers over the medium term. In South Africa, there are 37 million adults, of which 25 million are credit active, and about 10 million, or 40% thereof, are considered to be non-performing. Household debt to income remains elevated at about 73%. We see elevated levels of unemployment, with total unemployment at 29% and youth unemployment at 58%. And whilst inflation has reduced to about 4.1%, it still exceeds wage growth, which is less than 4%. Even when we look at our own index, the Transaction Capital Consumer Credit Rehabilitation Index, we see that this remains at very low levels. And now, further headwind is expected from COVID-19, which will adversely impact the consumer credit sector, as we expect lower credit yields, reduced credit extension, pressure on consumers' disposable income, no work, no pay policies, and increased unemployment. In Australia, we see that the Australian consumer is highly leveraged but employed, with increased unemployment and emerging risk in the short term. We see persistently high levels of household debt to disposable income, sitting at about 190%. And the Aussie bushfires have placed strain on an indebted consumer. Economic activity is now low due to COVID-19, and the Royal Commission into Banking has caused a reduction in the sale of NPL portfolios and a reduction in credit extension. Despite this environment, Australia is a large market, providing TC with an opportunity to grow its agency business and take a position in the larger NPL acquisition market, where we have a tiny market share. I will now focus on a few strategic growth initiatives to create value. Slide 30 shows that the South African market to acquire NPL portfolios is small, underdeveloped, but growing, with TCRS leading the expansion of this market by introducing new sellers into the market and expanding our asset classes. Historically, TCRS focused on acquiring unsecured written-off consumer debt. We are now also acquiring NPLs sold prior to write-off, NPLs collected via a legal process, and NPL portfolios sold on a bilateral or recurring contractual basis. In addition to all of this, consumers are expected to go into NPL status post-COVID-19, presenting TCRS with a further opportunity to acquire NPL portfolios. For all of these reasons, the acquisition of NPL portfolios to be collected as a principal in South Africa remains a strategic growth initiative. Finally, I draw your attention to the larger Australian NPL consumer market, where we have a very small market share, and the European distressed debt and specialty finance markets, which I will now discuss on this slide. TCRS continues with its strategic initiative to acquire NPL portfolios in Australia. This year, we invested 73 million rand in Australian NPL portfolios, up from 33 million rand in the period before. Another strategic growth initiative is for TCRS to enter the fragmented segment of the European distressed debt and specialised credit market. 8.7 million euros has been invested to date, with 7.4 million euros invested in the last 6 months. Initial returns are in line with expectations, and we will follow a conservative approach over the short term as the European specialist credit markets settle. We see these initiatives as an opportunity to leverage TCRS's high IP and low-cost infrastructure with the ultimate intention to own a scalable servicing platform of our own. A small position in these sizable markets provides a meaningful growth opportunity which will further diversify our revenue model, expand our total addressable market, and expand our earnings base, all within TCRS's existing skill set and competencies. Whilst the strategy remains valid over the medium to long term, over the short term, we expect a reduction in the acquisition of NPL portfolios due to our conservative and selective approach. We believe that it is prudent to retain our undeployed capital allocated to Australia and Europe to now be available to bolster liquidity only if required. Slide 32 shows that TCRS is buying well and collecting well. During this period, TCRS invested 483 million rand into South African NPL portfolios, compared to 404 million rand in the prior period, and we invested 73 million rand into Australian NPL portfolios, compared to 33 million rand in 2019. The carrying value of purchase book debts is up by 64% to 2.8 billion rand, and revenue from principal collections increased by more than 20%. Looking forward, estimated remaining collections increased by 44% to 5.3 billion rand. TCRS's strong financial position continued during this year. Headline earnings increased by 16% to 158 million rand. Non-interest revenue increased by 19% to 1.1 billion rand, and organic revenue from collection services increased 23%, driven by SA collections revenue up by more than 20%, and Australian collections revenue increasing by double-digit percentages, despite the difficult consumer environment, the bushfires, and COVID-19. The cost-to-income ratio improved again to 79.4% from 80.1% in the prior period. My final slide covers shareholding, dividend, and the board of directors. I've already mentioned that no interim dividend was declared to preserve financial flexibility and liquidity. Until next time, stay safe, stay healthy, and stay productive.